On Unit 4 of Applied Corporate Finance, and in this particular video we're going to talk about how do we arrive at the optimal capital structure and what are the approaches to arriving at the optimal capital structure, and we'll then try and discuss one of those approaches in this particular section. So there are various approaches in terms of arriving at the optimal capital structure, and consequently these approaches are kind of put in four broad categories. The first one is called the cost of capital approach, wherein we are saying that the debt equity ratio should be one that minimizes the cost of capital for a firm. The second one is called as the operating income approach, which says that we extend that a little bit further and say debt equity ratio should be that minimizes the cost of capital and also at the same time tries to maximize the operating income of the firm. The third one talks about an adjusted present value approach, which says the optimal debt ratio tries to maximize the overall value of the firm. And the final one assumes that the sector averages are the best debt equity ratio. And so the ratio should reach closer to the sector averages, right? Now, we will look at the first one in this particular section and try and understand as to how can we arrive at that debt equity ratio, right? We already know how to calculate the cost of capital for a firm. So that's the weighted average cost of capital formula that we know of. And it uses the debt to capital ratio and the equity to capital ratio. And while in theory we should be using the market values, in practicality we should be using the market values. For the purpose of this discussion, we can probably try and use both the market and book values and try and see what happens, right? Now the idea is to find the level of debt equity which minimizes this cost of capital, correct? Let's say, argument's sake, the cost of equity is 13% and the cost of debt is 10%. So 1 minus the tax rate gives me 7%. Then I have to find the weight of debt and weight of equity that minimizes this entire equation, right? Now, we might argue that weight of debt should be equal to 100%, because in that case this equation will get minimized, right? So why should it not be 100% debt, right? Because if this is 1 and this is 0, that's when WACC will get minimized. We'll get the minimum value for WACC mathematically, right? What is wrong with this assumption? What is wrong with this assumption is that the equation is dynamic in real life, which means what are the dynamic parameters? Cost of equity and cost of debt. Both of these are moving in real life. They're not fixed in real life, right? So it is not 100% debt for a firm since the equation is dynamic. Both cost of equity and cost of debt will change as we get more debt in the firm. In fact, both of these will go up, right? Cost of equity will increase since beta of the firm will increase. Why will this increase? Is because risk of the firm is going up. And as the debt increases, with more debt, the credit rating suffers. The credit rating goes down from AAA to maybe BBB and then to CCC and then lower further. And that will increase the cost of debt as well for the firm. So both cost of equity and cost of debt in this equation, weight of equity into cost of equity plus weight of debt into cost of debt, both the cost of debt and cost of equity will go up as debt to equity ratio goes up. As the firm keeps borrowing, in a dynamic world, this will change, right? And it's logical as well. If I keep borrowing money and I keep going to the bank borrowing more and more money, then at some point of time the bank will will start increasing the interest rate, and then at some point of time they'll stop lending me, right? All together. So that's the broad idea. Now we have to go ahead and apply this entire concept to Apollo tires. So let's try and calculate this for Apollo tires. To be able to find this, we need to find the debt equity ratio that minimizes the cost of capital. And for that, we will need the following. We'll need the risk-free rate, which we have calculated earlier. That's about 5%. We need equity risk premium. That's about 8%. We need to calculate the debt equity ratio of Apollo tires. we need to calculate the beta for Apollo Tyres, and we need a sort of a debt rating schedule, which is how ratings change with debt to capital ratio.